Good evening, ladies and gentlemen, and welcome to our class on Fibonacci and Fibonacci tool and retracements. Tonight's class is sponsored by LegacyFx, one of the world's leading providers of regulated Forex trading and CFD trading. They are regulated and authorized by CISIC, Cyprus Securities and Exchange Commission, and they offer an exceptional trading environment. They offer 4 different platforms. Whether you want to download the world's leading MetaTrader 4 platform for professional style trading, or you want to use their web trader, which is easy to use, no download, and just use your username and password, you can also use their Zurich station and their mobile trading platform. As you can see, the platform is set up easy to use. All the information is dynamic and easy to see. It's a very user-friendly environment, and you can set up your screens to be any which way you want. It's all customizable. Now, also, LegacyFx offers one of the best education services in the marketplace because they want you to be a successful trader. So they offer fast deposit and withdrawals with many different types of services. They offer their Legacy Forex Pro awards program. They have outstanding security and an incredibly deep trading academy. Now, Legacy is a regulated provider, so I'm required to give you a risk warning. So let me read that and get it out of the way. Spread bets and CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. 76% of retail investors' accounts lose money when spread betting or trading CFDs with Legacy. You should consider whether you understand how spread bets and CFDs work and whether you can afford to take the high risk of losing your money. Legacy provides an execution-only service, and therefore any market analysis, opinion, commentary, or other information which provided during this webinar is for educational purposes only. Now, tonight's class is being recorded. And if you want to see a recorded version of tonight's class, you can do that by using the same link you used to attend this evening in about 24 hours, and you can see an unedited version of tonight's class. Down the road, when investing.com has had time to edit the presentation, you'll be able to find it on the investing.com website under webinars or under education, and then webinars on demand. And in fact, you can go there and see all of our past webinars that we've ever given up at your convenience. But tonight's class will be available down the road, but you can see an unedited version by using the same link used to come to tonight's class. Now, in tonight's class, I'm going to use the term security when referring to any tradable financial instrument. I may use the word asset. Okay, I might just say a specific asset, but I'm talking about all the general marketplace. This includes indices, commodities, futures, bonds, CFDs, cryptocurrencies. Okay, it just gets very boring saying security, security, security over and over again. So all the concepts we're talking about tonight, which will be Fibonacci, fit all assets that are traded in the open marketplace. Now, also, I kind of intermix the term investing and trading. Okay. Now, tonight, most of us are traders. We're looking for short-term positions to make short-term profit, while investors are looking for longer-term investing opportunities. But the fact is, the concepts we're talking about tonight and the techniques are equally adept for either type of trader because they're adjustable by the time frame in which you're looking to be. So an investor would be looking at 1 day charts, 1 week charts, 1 month charts, and Fibonacci works just perfectly on them and adjusts to the time frame that you're looking at. While as if you're a trader, you can use Fibonacci in a 15-minute chart or 1.5 hour chart. Now, a lot of people think that by using some of these indicators and tools that they can get the answers to these incredible questions. Should I buy today? What will the prices be tomorrow, next week, or next year? Wouldn't investing or trading be easy if we knew the answers to all these seemingly simple questions? But alas, I don't have a crystal ball or Ouija board. So if you're attending this class tonight in the hopes that technical analysis has the answer to these questions, I'm afraid I have to disappoint you, but it doesn't. However, if you're attending this class tonight in the hopes that technical analysis and the use of Fibonacci will improve your investing and trading, I have good news for you. It will do that. So let's talk about using Fibonacci. Now, before we can do this, we have to talk a little bit about what this Fibonacci is all about. Now, Fibonacci's are ratios used to identify potential reversal levels in the marketplace. Now, these ratios are found in what's called the Fibonacci sequence. And the most popular Fibonacci retracements are 61.8 and 38.2. Now, I know a lot of you out there are saying, well, he forgot 50. Well, the fact is, we use 50 in the Fibonacci tool, but 50% retracements have absolutely nothing to do with Fibonacci. The 50% retracement comes from Dow theory and Charles Dow. But because it is such a popular retracement level, it is added into the Fibonacci tool. So let's first talk about where these numbers come from. And these numbers come from a sequence, and then how the sequence gets put into these ratios. Because you have to understand a little bit of the background before you can actually use the tool. Now, we're not going to delve into the complex mathematical formulas of how we get to the Fibonacci sequence or the golden rule, but let's start out by understanding what this sequence is. The sequence is a chain of numbers. Starts out with a 0. If we add 1 to that 0 and add the 0 and the 1 together, what do we get? We get 1. If we then add the 1 and the 1 together, we get 2. We add the 1 and the 2 together, we get 3. We add the 2 and the 3 together, we get 5. Add the 3 and the 5 together, we get 8. And so on 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 until infinity. It's said that it actually comes from observing rabbits and rabbits multiplying. Because you start out with no rabbits, you have 0. You add 1 rabbit, it stays at 1. But as soon as you add the second rabbit, we get 2. And those 2 will give us 3. And those 3 will give us 5, and so on and so on and so on. Now, it is a complex mathematical formula, but we don't care about it. But we start out with this sequence. Okay? We have this sequence. But this sequence has very little to do with helping us trade in the financial markets. And Fibonacci's been way around, way longer than financial markets, online trading, Forex, and CFD trading. So we start out with the sequence. Sequence isn't difficult to understand. 0, 0, 1, 0, 1 plus 1 plus 0 is 1. 1 plus 1 is 2. 1 plus 2 is 3. We get it pretty easily. Now, we have to convert these to ratios. Now, again, this has nothing to do with financial markets. Okay. But if we were to take the number in this sequence, and once we have this number in the sequence, divide it by its next number, its previous number, we're going to get 1.618. Okay. Now, so in other words, if we were to take the sequence up top here, and we were to take the last number here and divide it by the previous, which is the 13, in this case, we got 1.6153. If we were to go to the next, which would be a 34 and 21, we get 1.619. It would always be 1.61 something towards the top. So it is approximated at 1.618. Okay. Well, that's a Fibonacci, what's called a Fibonacci extension. Okay. But this is the first number in the ratios. If we were to go by there and go one step farther and take a number divided by the next highest number, so in other words, we're reversing exactly what we did above. Here we took 21 and divided it by 13, or we took 34 and divided by 20. Here we're going to reverse it. We're going to take 13 and divide it by 21. So we're going to take this number from the sequence and divide it by its next number in the sequence. When we do that, it's always going to give us 0.61 approximate 8. So if we take 21 and 34, it gives us 6176. Take 13 and 21, 619, 34 and 55, 6181. And 55 and 89, this gives us 6.179. If we take it out into infinity, it's always going to fall in this range. So it's approximated at 61.8%. Okay. Now, it's important that you understand that these are approximations, because we're not starting out with finite things. So therefore, when these sequences are put onto the financial tables, even though it might drop right on at, say, the euro at 130, 113.22, it is not a finite number. It's only an approximation. So if we were to go to the next level and we were to take the 13 here and divide it by 2 digits out, so in other words, the 21 plus the 30, the 13 plus the 21 would give us 34. And so we would divide the 13 2 digits out by the 34. That would give us 0.382. Now, funny thing is, if we were to take 0.382 and add it to 0.618, guess what we get? 100% or 100. If we were to divide it one step farther, so the 13 by 3 digits away, because the 21 plus the 34 would give us 55, and we were to make that and divide it by the 13, that would give us an approximation of 0.2359 or 0.2361, which is then approximated at 0.236, which is our next Fibonacci retracement at 23.6. So what do we have? We have 23.6, we have 38.2, we have 61.8, and 161.8. And there are more. You can go out and keep setting, go another decimal, and there are lots of ranges for the Fibonacci sequence. But the most popular in the financial markets are the retracement at 61.8 and 38.2 and 23.6. And then, of course, like I said, we dropped 50% in. Okay. Now, when you say retracement, what exactly is a retracement? Well, before we talk about retracements, let's talk about these ratios. Because like I said, these ratios had nothing to do with the financial markets. They've been around a lot longer than we've been trading, corn and oats and wheat and Google and Apple. Now, the 1.618 refers to what's called the golden ratio, or the golden mean, which is called phi, which has been around in ancient history all the way back to the ancient Greeks. And the inverse of the 1.618 is 0.618. And these ratios can be found in nature, architecture, art. And it's the proportion of the 618 to 1 is a mathematical basis for the shape of playing cards, the Parthenon in Greece, sunflowers, snail shells, Greek vases, and also the spiral of the galaxy. It's actually said that beauty in humans is based on the proportion between our eyes, nose, ears, and mouth. And these proportions fit these ratios. And the closer you are to these ratios, the more beautiful you're said to be. Because in our eyes, we see this as well balanced. We don't understand it, but this actually is exactly what it means. And the Greeks based much of their art and architecture. They called it the golden mean. Now, how do we go from the ancient Greeks up to Bitcoin trading? Well, an asset will often pull back or retrace a percentage of the previous move before reversing. And these Fibonacci retracements often occur at these levels, 38.2, 50, and 61.8. Okay. Well, okay. That sounds like it's a magical, mystical, Beatles song or something. So let's talk about what, first of all, if you understand how trends work, okay, prices don't move in a straight direction. They'll move in an uptrend or a downtrend, but a well-balanced uptrend is a push and an ease, a push and an ease, a push and an ease, push and ease, push and ease. Because, first of all, it takes a lot of energy to push an asset up or down in a downtrend or uptrend. Okay. And the traders get tired. They'll push the market up. At some point, those traders are pushing really hard, sit on the sidelines. New traders haven't come in, and they have to take a break. It's not really why it happens that way, but that's how you can explain it. These pushes and eases, or the peaks and valleys, are what makes up a well-defined trend. Because what happens is traders will enter the market because they think an asset can go up, and they'll buy it. And more buyers will enter the marketplace. At some point, the buyers move to the sidelines because they say the price is getting too high. Also, the buyers who bought down below have hit their target price and they're selling because they've made their profit for the day, the week, the month when it reaches this whatever price it was. So they're selling, and the other guys are sitting on the sidelines. So what happens? The price starts to fall because there's lower demand. Okay. At some point, as it reaches this lower demand, these buyers who are sidelined says, okay, it's come back to where I feel comfortable buying, and they start buying into the marketplace, and more buyers jump in and push the prices up. Okay. This is a proper normal course of action in a developed trade. Now, not all uptrends are going to run push, ease, where we can actually measure what this ease is. Okay. But we want to know when we're looking at this movement whether that trend has lost its feet and is about to turn down, or is it simply retracing and going to move on its way up? So Fibonacci, based on the prior move. So if it's market's moving in an uptrend now, it's going to take the beginning and the end of the previous downtrend. And the markets are said that the next move will tend to retrace 38.2% of the prior move, 50% of the prior move, or 61.8% of the prior move. Well, let me share with you a little presentation on retracements and reversals, so you'll understand a little bit better what we're talking about here as the market moves up or down. And then we're going to go look at how we would then drop the Fibonacci or use the Fibonacci tool and drop it onto our current price charts. Okay, so as you can see, now hopefully you've got some understanding of what a retracement is. Now let's go over to a live chart. And okay, so we're looking, let's change this to a 1 hour chart. We're looking at the Euro US dollar. And we can see it's really trading in a downtrend. So we need to find the previous uptrend. Okay, and we need to locate what's called the swing high and the swing low. Now, these are the critical top and bottom of the trend that has ended. Okay, because we have to use that to analyze the current trend that we're in. So what we would look for is the critical or the crucial swing high and swing low. Okay. And this can be sometimes described as when two candles is we're looking for the top and the bottom of the trend. But we might look for two candles next to each other that have the same tops because we need to get it on pretty precisely. We might, so down here, we might look at this or this level and mark this as our swing low. So we have our swing low here and our swing high here. Okay. Now we would go over here to the right once we've located these, and we would come over here and look in our tools to find our Fibonacci retracement tool. Okay. And we would click on our Fib tools and we would put it on our chart. Now, it's not that easy. We have to first decide which way to drag this tool. So in order to find these Fibonacci retracement levels, you have to find the recent significant swing high and swing low. Then for downtrends, click on the swing high and drag the cursor to the most recent swing low. For uptrends, we do the opposite. So we would click on the swing low and drag the cursor to the most recent swing high. So let's go back to the chart. And we're in an uptrend. So we're going to take our tool from here and we're going to drag it to there. So let's turn on our tool. And we simply click here and we take it to here. And then we can extend it forward all the way into the future. And now we have our Fibonacci tool put on our chart. And then we can set, because we're not concerned with the, well, we're going to leave on the 23.6, the 38.2, the 50, the 61.8. We're not concerned with the 71.6. We'll leave on the 1 and the 61.8. We don't need the rest of these extensions. You might want to use them. I'm not going to use them for class because they go on forever and a day. So and then you might want to color code these. So use red for the top and the bottoms. And we'll use blue for the next level. We'll use green for the next level. And we can leave on orange for, we'll use purple for the 50% level. Don't need to be able to, you don't need to color code them all. It's completely up to you. Or you can just click on rainbow. Okay. So now we, actually, let me make them thicker because we can also, let's use a trend line and a level line thicker. And we also want to use the prices on levels and our percent. This allows us to see them right over here and see what levels are on. So we've set it all up pretty well. So now we have our Fibonacci's dropped onto our chart. And Labels on the right. Okay. So now we can see right on our chart, we can see this is the 50% retracement level, and that's at 1.148 for the euro value. This is the 38.2 retracement. This is the 23.6. This is the 61.8, and this is 100%. Now we pulled it out into the future, so then we can slide our charts over because we want to. We're only concerned with the current prices. Now, we're at bottom, as you see, coming down here to 100% retracement. And most likely it will then bounce off and turn into an uptrend again. But we can notice now, as price has been falling down, okay, as price came off of here, it broke through the 23.6, came right down. Look at this low coming to 38.2, but wasn't able to sustain it. Bounced off and came right back above the 23.6. But now I've dropped down and it stayed above the 50%. Look how well 50% traded, the 38.2 and the 50%. I mean, this was a beautiful trading period right here where you could have been trading off, bouncing off and up and down off the 38.2 to the 50%. As price can then return to its downcline, look at how well the 61.8 held here. So this helped us give us levels of support and resistance in our trading, and it will help us make trading decisions. But if you were in the market and say you were trading this downtrend, you had entered this downtrend here, okay, you need to know when you need a panic or when you're having a normal retracement. So as price came through the 23.6 and was unable to come to the 38.2, we would feel pretty well content. Okay, bounced back off, came back up here, and we're not panicking because nothing is showing us price reversal. We're just seeing retracements of the current price. Remember, in a downtrend, push, ease. I'm sorry, push, ease, push, ease, push, ease, push, ease. And what we're looking for is we're looking to be alerted when price is ready to move into a reversal or stay in the market if price is simply retracing. And this is very easily done using the Fibonacci tool. Now, also, before I we move to the next step here, tonight on your screen, you'll see that there are a place to download the handouts I gave you. I've put together a very particular, specific handout on Fibonacci retracements. It's several pages long and explains everything in great detail for you. And we'll show you how to incorporate this and how to check, make sure you get done your charts right and everything. Please click the download button because you cannot get this except in the live class. I've also given the investing.com ebook on Introduction to Technical Analysis. And this is a complete, well-defined ebook that will show you all the technical analysis, or all parts of technical analysis, but it also has a very nice section on retracements and reversals, as well as understanding what the difference between lower lows and lower highs and higher lows, and a very nice section on the Fibonacci tool. So please click the download buttons and download them now because, like I said, they won't be accessible any other way except in this live class. So when you see the recorded version of tonight's class, you cannot access them from that point. Okay. So let's go back to my PowerPoint. And now that you know how to put these on our charts, let's try to talk about what we're looking at on our charts. Okay, so in an uptrend, we go from the swing low to the swing high. In a downtrend, we go from the swing high to the swing low, measuring the previous completed move. Now, so in order to apply Fibonacci levels to your chart, you need to identify swing high and swing low points. Now, one of the ways, and remember I said in the very beginning, the crucial, critical swing high and swing low. Because assets do all kinds of trading and moving. And sometimes the low isn't a critical swing low. So a swing high is a candlestick with at least two lower highs on both the left and the right side of it. And a swing low could be a candlestick that has at least two higher lows on both sides of it. You have to decide. There's many different ways that you can define crucial swing highs and swing lows. I use my eyeballs. I look for a low that is a significant swing low to the price. I look for a high that's a significant swing, not just a peak up because the markets went crazy for a minute or some headline came out or Donald Trump said something. So when using the Fibonacci tool, the probability of trading success could increase when used with other support and resistance levels, trend lines, and candlestick patterns for spotting entry and stop loss points. So remember, I told you when we were looking at the calculations that these are our approximations. So I call them alert zones. Retracement levels alert traders and investors of a potential trend reversal, resistance area, or support area. Retracements are based on the prior move. A bounce is expected to retrace a portion of the prior decline, while a correction is expected to retrace a portion of the prior advance. Once a pullback starts, charters can identify specific Fibonacci retracement levels for monitoring. As a correction approaches, these retracements, chartists should become alert for a potential bullish pullback. So let me show you a chart that's actually used Fibonacci in its trading strategy. So here we can see on the right the 61.8 Fibonacci retracement or extension, and as well as a major support line from our support and resistance. You can see the Fibonacci level here at the 61.8 level and our major support line here. Okay. We have our resistance line here and we have our second resistance line here. Okay. And so we're in an uptrend, and we can see this is based on the previous downtrend. And what we're doing is when we combine this with other tools, we can look at the slight difference between the Fibonacci level and the major support level. So that's telling us this price at 485.7 is critically important. Okay. We can see that our 61.8 extension level gave us our first resistance level, and our first resistance and our 61.8 level. That's telling us anywhere between the 510 and the 506 is very, very important. And we'll look at that. We see how price moved right up there, stayed above our support line, moved up to that resistance line, and now is bouncing back right off just as it was projected. And we will expect it to decline back down to this trading area. Oh, hold on a second. Now, keep in mind that these retracement levels are not hard reversal points. Instead, they serve as alert zones for a potential reversal. It's at this point that traders should employ other aspects of technical analysis to identify or confirm reversals. These may include candlesticks, price patterns, momentum oscillators, or moving averages. So the Fibonacci retracement tool on most charts will show you four common retracements: 23.6, 38.2, 50, and 61.8. From the Fibonacci section above, it's clear that 23.6 and the 38.2 and the 61.8 stem from ratios found in the Fibonacci sequence. The 50% retracement is not based on Fibonacci. Instead, it is based on Dow, but because it's such an important retracement level, it is included in the Fibonacci tables. Now, let me show a little presentation here on how you would use this in your trading and how we can use these tools more successfully. So if you've been paying attention, you'd know by now that you can combine the Fibonacci retracement tool with support and resistance levels and trend lines to create a simple, super awesome trading strategy. When combining the Fibonacci retracement tool with candlestick patterns, we are actually looking for exhaustive candlesticks. If you can tell when buying or selling pressure is exhausted, it can give you a clue of when price may continue trending. Now, how do we use these to trade? Like you saw in the presentation, you can use Fibonacci's to find entry points and exit points and to place your stop loss and take profit points. Using the Fibonacci stop loss approach is especially interesting because it offers a more objective way of placing stops. Whereas the trader has to make decisions subjectively when to move a stop based on the moving average or swing strategy, Fibonacci levels don't have this component. Once a trader has drawn the Fibonacci levels, they don't move anymore and the potential stop loss are well defined. In the example here to the right, the trader drew the Fibonacci tool during the downtrend and then used the retracement levels on the right to trail his stop loss. The trade exit happened once price failed to move to the next retracement level. So you can place stops just beyond the next fib level or slightly beyond. And you can go to, if you're at 38.2 retracement, you can look at placing your stop beyond the 50%. But remember, you always have to apply your risk management to make sure that you can afford to make that trade when you see where you have to place your stops. Now, if you want to be a little safer, another way to set your stop would be to place them past the recent swing high or recent swing low once it broke the Fibonacci level. This type of stop loss placement would give your trade more room to breathe and give you a better chance of the market to move in your favor of your trade. So, which is better? The truth is, just like in combining the Fibonacci retracement tool with support and resistance trend lines and candlesticks to find better entry, it would be best to use your knowledge of these tools to analyze the current environment to help you pick a good stop loss. As much as possible, you shouldn't rely solely on Fibonacci levels as support and resistance points as the basis for your stop loss placement. Remember, stop loss placement isn't a sure thing. Know your entry and your exit level. So the first thing you should know about Fibonacci tool is that it works best when the 4S market is trending. If markets are moving sideways, it's really not helpful. Even if when you saw it tonight in our example with the Euro US dollar in the live chart, let me pop that back up on your screen. Once the market has started moving in this sideways congestion here, our Fib tool was of no help to us. When the market was downtrending here, we were perfectly fine. But at this point, forward, until the market makes some decision, the Fibonacci is not helping us in the least. So when you are placing an exit order, it's a good idea to place it just before the level you want to plan your exit at. You should practice it yourself, but my advice is to place exit orders a few points earlier than the exit level. When you're placing an exit order, it's a good idea to place it just before the level you plan to exit. You should practice it yourself, but my advice is to place exit orders a few points earlier than the next level. So Fibonacci retracements are often used to identify the end of a correction or a counter trend bounce. Corrections and counter trend bounces often retrace a portion of the prior move. While the 23.6 retracements do occur, the 38.2 to the 61.8 cover the most possibilities with 50% in the middle. The zone may seem big, but it's just a reversal alert zone. Other technical signals are needed to confirm a reversal. Reversals can be confirmed with candlesticks, momentum indicators, volume, or chart patterns. In fact, the more confirming factors, the more robust the signal. So hopefully tonight we gave you some little heads up on how to use Fibonacci. Remember, please click on the download buttons and download the 2 handouts that I gave you. And remember, you can come see a recorded version of this class using the link used to come to tonight's class, or when investing.com has had time to edit it, you can see it on investing.com under education and webinars on demand. But if you want to learn more, go to LegacyFx, that's www.legacyfx.com, and sign up for their education center. They have a huge amount of information, whether it's videos or content on Fibs, and they'll also talk to you one-on-one with a financial analyst who can explain it to you and answer your questions for you. So thank you very much for joining us. Have a great trading week. And again, thank you for supporting LegacyFx as well as investing.com. Good night now.